Mortgage defaults are surging across America right now at unprecedented rates. What we're witnessing could signal a major shift in the housing market landscape, with FHA loans driving 90% of the new delinquencies. But here's the twist. Despite these skyrocketing delinquencies, don't expect a foreclosure wave to hit anytime soon. And today I'll explain exactly why that may be more concerning for the future of the housing market. It's the beginning of a significant market disruption. Stay tuned as I reveal which states are getting hit the hardest with these mortgage delinquencies and what it means for the future stability of America's housing market. Hey, if you're new to the channel, welcome. My name is Jason Ferrier. I am the housing nerd, and I've been a realtor and investor in Central Ohio for the last 7 years. Think of me as your no BS guide to this crazy housing market. If you can, leave a comment below, like the video, share it, and subscribe to the Housing Nerd. I hope you learned something today about mortgage delinquencies that you didn't know yesterday. For today's video, we're going to use the latest Black Knight First Look Mortgage Report. Now, the national delinquency rate for all mortgages has climbed to 3.53%, with FHA loans accounting for 90% of the 131,000 additional mortgage delinquencies that we've seen in the past year, even though FHA loans only make up about 15% of all mortgages. Now, that 3.53% delinquency rate is actually an increase of 19 basis points versus 2024, but we're still 32 basis points below pre-pandemic delinquency level. As I mentioned earlier, FHA loans dominate the increase that we've seen in mortgage delinquencies. In fact, right now, total delinquencies for just FHA loans is 12%. And FHA loans that are actually 90 days or more delinquent, in other words, seriously delinquent, that's over 4% right now. So while total delinquencies are actually below pre-pandemic levels, FHA delinquencies and serious delinquencies are well above pre-pandemic levels. And the concentration of trouble for these FHA borrowers is particularly alarming because these loans typically serve first-time home buyers and low-income borrowers. Now, one of the reasons why I think we're seeing a huge uptick in FHA delinquencies is the fact that most FHA loans require very little money down, as little as 3.5% or even less. In other words, borrowers have very little skin in the game when they actually close on the loan. The debt-to-income requirements for FHA loans are also incredibly lenient compared to conventional loan products. And the debt-to-income is simply how much income do you make versus how much debt do you have. Current debt-to-income thresholds for FHA borrowers are as much as 43% up to 50% or more in some situations. Then you add in rising property taxes, rising insurance rates, increased repair cost on homes, and just the general cost of the increase in living, it's easy to see why just a small hiccup in monthly expenses can cause an FHA borrower, in particular, to not make their mortgage payment. What's worse is that FHA borrowers oftentimes, because of a low down payment they made, and if they bought in the last few years, have low equity in the house. So if they get into trouble, they can't afford to sell the house, and they can't bring that money to closing to make up the difference between what they can sell the house for and how much they owe. But what about foreclosures? Why haven't we seen more of these hit the street? Well, the foreclosure activity in this report tells a very deceptive story. While foreclosure starts decreased 17% and foreclosure sales dropped 11% for the month, they remain significantly higher versus last year, with foreclosure starts up 34%. Now, these foreclosure numbers would be dramatically worse if not for FHA's loss mitigation policies. And you may be saying, what is a loss mitigation policy? Simply put, the government during COVID implemented loss mitigation procedures to keep people from being foreclosed on, particularly with FHA and VA mortgages. There are several ways that the government has implemented these loss mitigation measures. Everything from modifying the actual mortgage to lowering the interest rate on a mortgage to even extending the term. And there are a lot of borrowers right now who are mortgage payments, and the government is taking those payments, allowing the borrower to put them on the back of the loan in a 0% second loan. That effectively allows many borrowers to just not make mortgage payments. The government will make those payments for the borrower to the loan servicer or the bank that originated the loan. And these loss mitigation measures are really a double-edged sword because on one hand, they keep people from being foreclosed on, which in many cases is a good thing. However, there's a lot of folks that have taken advantage of this situation. In fact, some people haven't made any payments since they actually closed on their home. Can you believe that? So comment below and tell me what you think about these loss mitigation measures. These loopholes are supposed to end in February of 2026. But the problem is all these loss mitigation measures have artificially suppressed the number of foreclosures that we would normally see. Because right now there's over 500,000 borrowers who are more than 90 days or more past due. And typically those would go to foreclosure, but not right now. These policies are creating a massive backlog of mortgage delinquencies that the government, banks, and reporting agencies are effectively hiding, postponing a reckoning that eventually will have to be addressed. The current foreclosures are really just a tip of the iceberg because beneath the surface lies a growing backlog of foreclosures that eventually will have to be unleashed or forgiven altogether. The 34% year-over-year increase that we've actually seen in foreclosures coincides with the VA foreclosure moratorium. Because over the last few years, the VA has put a program in place that blocked any foreclosure on a VA loan. We saw a big increase year over year in the number of VA foreclosures because the moratorium just ended at the beginning of 2025. There's no doubt natural disasters like hurricanes and fires are definitely making the delinquency and foreclosure problem much worse. For example, the data shows that 4,100 homeowners in Los Angeles missed a mortgage payment last month. And that represents a six-fold increase from January's delinquencies when they were just 700. Some of the other states where you're seeing a lot of delinquencies right now include Louisiana, which has a delinquency rate of 8.25%, Mississippi, Alabama, Arkansas, and Indiana. And when we look at serious delinquent mortgages, those that are 90 days or more past due, Louisiana, unfortunately, takes that top spot again at 2.22% of all mortgages are 90 days or more delinquent. And then Mississippi, Alabama, Florida, and Georgia are in the top 5. One of the more shocking numbers is in Florida, where the increase for seriously delinquent mortgages was up 67% year over year for February. And so while the number at 1.57% is still pretty low, that number is growing and growing fast. Understanding these state and regional numbers can kind of give us an idea of where delinquencies and foreclosures could grow in the near future. But we're now at a serious inflection point in this crisis, with several possible outcomes that could drastically shape the future of the housing market. One possible outcome could be that the current administration extends and even bolsters the loss mitigation measures that we have in place. And that would really just extend and pretend the pain, kick the can down the road, and make the problem even worse in the long run for somebody to actually deal with. On the other side of the spectrum, you could just end all the loss mitigation measures right now. That effectively would unleash a torrent of foreclosed homes into the housing market. And some think that's what we should do. Is that you? Comment below. I'd love to know. And that flood of foreclosures, by the way, could easily dwarf the 2008 crisis. The middle path could be to let the loss mitigation procedures we have end as planned in February of 2026 and slowly allow more foreclosures to hit the market and also create long-term solutions for those loss mitigation programs. Again, personally, I'm all for helping folks stay in the home if they run into a problem in their life, but I'm not for people to kick the can down the road and basically make no mortgage payments even though they can afford to make them. With FHA loans representing the vast majority of these new delinquencies, any policy decision will have huge effects on not only first-time home buyers, but lower-income Americans, and certainly most neighborhoods throughout the U.S. Regardless of what path emerges, these delinquencies should serve as early warning signs for homeowners, future homeowners, and certainly policymakers. The data doesn't lie. Mortgage defaults are surging right now, and ignoring these warning signs could prove catastrophic for American families, neighborhoods, and certainly the housing market. Now, if you want to dive deeper into these hidden delinquencies and how these loss mitigation measures are really masking the true health of the housing market, you should check out one of my recent videos I did right here.